Hey everyone, it's Kirk here again at Option Alpha. So in this video, I want to go through backtesting versus paper trading for options and essentially give you my take on which one is better for learning how to trade options or finding a trading strategy. So first thing we have to talk about, of course, is what is the difference between them. So this is how I visually think about it. I think about it as you have today, like where we are right now when you're watching this video. Backtesting is the ability to test things that have happened before in the past. So it literally is backtesting because you go back in the future, you look at historical data, basically whatever has happened in the market, and you test a strategy using that historical data. So if I have a strategy now, I would backtest it and see, would this strategy have done well in the last year, 2 years, 3 years, 5 years, 10 years, whatever the case is. You're going back in time from today. Paper trading is a little bit different. Paper trading is forward testing. So paper trading is today moving forward. That is taking your strategy that you have, turning it on live, especially if you're running like a bot or an automated strategy, is turning that strategy on and then testing it, seeing how it performs moving forward. So this is a little bit different, of course, because we don't know what's going to happen. So the strategy or the market, whatever you're doing has to adapt to the current market environment, to new prices, to new moves that we've never seen, to new volatility events that we've never seen. So there's obviously some benefit to that as well. So I want to go through in this video what I think are the major, differences and, drawbacks and benefits of these and how I use both backtesting and paper trading in my own trading strategy. So the first thing, and I just created this little like Venn diagram to kind of show you the differences, but if we kind of grouped these or separate these out and said, okay, backtesting and paper trading, what are the differences? What are the similarities, et cetera? Obviously, the major similarities between them is they're risk-free and they're educational. So there's one hidden one that I haven't shown yet, so I'll reveal it at the end. That's the major similarity between these. But right now, the key thing to remember is that both backtesting and paper trading, it's risk-free. It doesn't really cost you anything to do these things, right? So you run a back test, you do some paper trading, you don't really risking your money. And the most important point, of course, is it's educational. You're trying to find out what works and what doesn't work. So let's look at back testing first, and then we'll go to paper trading. So the first thing you have to know about back testing is, of course, it's all historical data. So again, you're going from today as a point in time, and you're going back in history, and you're seeing what happened with the strategy going back in time. And so that means, of course, you're going to use a bunch of historical data. That also means it's going to be very fast and repeatable. So you can very quickly cycle through many back tests, because if you have the data and you have a system to run back testing, then you can go through those back tests very quickly. You can test new ideas and new strategies and new ways of doing things. So it's very easy to go back through and test a bunch of stuff. So here's an example really quick inside of Option Alpha, just 3 random strategies that I threw together and back tested. But again, you can see long-term performance of these 3 different strategies going back in time. One was an SPX Iron Condor bot at 3:30. The other one was a short put spread at 12 o'clock. The other one was an Iron Condor at 2:30 with some additional kind of technical indicators thrown in there as well. And again, you can see how this might have performed historically. It takes a few minutes, few seconds, depending on the test that you're running, to see all of this data. And I can quickly redo these back tests over and over again. So again, the value for back testing is, of course, it's very fast. It's super repeatable, so you can iterate very quickly on it. It does have no emotions because you're not tied to anything. So when you run a test, you know that it's done in the past. It's very historical. So you really don't have any emotional connection to that as well, which can be good or bad depending on how you look at it. But I think in some cases it could be good. So you're not tied to it emotionally, but eventually if you do turn it live, you will be tied to it emotionally. So maybe there's a little bit of disconnect there where you should be a little bit emotionally tied to it or have some skin in the game, if you will. The biggest downside, of course, to backtesting is the ability to potentially find yourself in a curve fitting scenario, and you have a bunch of hindsight biases. You have, survivorship bias, like the strategies that just survived ended up being the ones that, came in. It doesn't mean that the other strategies were bad. It's just these ones actually survived. You got a lot of hindsight bias where you say well, I knew the market went up, so I'm going to test a strategy where the market was going up, right? And maybe the next 10 years the market doesn't go up. So there's a lot of that you have to look out for backtesting. But I think the key for me with backtesting is finding things that you can find that are pretty robust, that kind of give you some guardrails, and we'll talk about that here in a little bit. The next thing, of course, is paper trading. So if we look on the other side of this diagram here, paper trading is forward data. So we don't have that data yet because we're going to be paper trading moving forward in time. So we're going to start a bot or start a strategy and start running it in a paper trading environment moving forward. So that means we're going to be using forward live data as we go. It means that we don't have the next 10 years. I wish we had the next 10 years of price data on the market, but we don't. We just have every day that comes along. And that does mean that it's very slow and limited. And so this is probably the biggest downside I see to paper trading is, of course, one of the biggest downsides to paper trading is that it's slow and limited. So you can only paper trade today, and then tomorrow you can paper trade tomorrow. So your data pool is very, very slowly growing over time. And so you don't get a lot of data out of paper trading. You don't get this mountain of 4,000 trades that you could potentially do in all these different market environments. It's hard to do that because you just don't have the foresight to know what's going to happen in the future. And so the problem I see sometimes with paper trading is, of course, it just takes a long time. So here's an example, and doesn't mean you shouldn't do it because I'm still doing it, obviously. There's a purpose to doing it, but this is one of the drawbacks to me. This is a strategy that I started back in early 2023. So I've been paper trading this as a testing strategy along with some other versions of this for other tickers. But it's just one bot that's been paper trading. This thing's been running for over 2 years now, right? So I started this in April of 2023. We're now in July of 2025. So for 2 years, this thing has been running. And it's only made, in this particular instance, 15 trades. Now, over that time period, the 15 trades is not statistically significant, not even close. It's not even close to the number of trades that it would need to make, but that was just what we were given in the market environment that we were trying to find these specific types of trade ideas. And so this, I think, is potentially some of the drawback to paper trading. Not that it's not valuable, because it is, and I'll show you again in a little bit how I use it for my own trading. But you can see here that it takes a long time for those strategies to potentially work out and for you to get enough confidence to maybe then turn this thing on live. So I'm not yet at the point with this particular type of strategy to turn on live because I don't have a lot of research on it. I don't have a lot of data on it. And the paper trading that I've done has only yielded 15 positions over 2 years. All right, so jumping back in here, the other thing for paper trading that we have on this side is it has minor emotions. And I say minor emotions because when you're paper trading, you still, although you don't have money at risk, so you kind of just, write it off to a certain degree. You're like, oh, it's paper trading. It's not real money. You're never going to get the emotions and the feelings you have when it's real money. But you do have a little bit of minor emotions where you do have a little bit of that anxiety, if you will, of what's going to happen to the strategy in a live environment, and the market's down today or the market's up today, and what happens to my strategy? How is it performing? And I think some people oddly tie their, emotional worth as a trader to some degree to how their paper trading strategies perform. And I think that's a little bit wrong. It's maybe going too far, but you do have a little bit of minor emotions. It does gear you up to a certain degree to start trading live. So maybe there's some value in that. I think one of the biggest valuable things that you do have for paper trading, and this is helpful depending on how you actually set up your paper trading. It can be detrimental if you don't set up paper trading the right way and you use paper trading completely wrong, which is very easy to do. But if you do use paper trading the right way, you can compare theoretical to actual results. So the value in doing that is you have some data, you can run both your real strategy, your live strategy at some point, and then you can also simultaneously run a paper trading bot right next to it, exactly the same type of bot, to see how closely you can get those things together and how far they deviate from one another. And ultimately, if you can get them pretty close together, you know that the way that you're paper trading is acceptable, it's appropriate, you can start testing other strategies. If they start deviating really widely, then something's off, right? Either your paper trading is not set up correctly, because that's usually the case with wide spreads and not using bid-ask spread guards, things like that, or you've got something wrong in your strategy and you need to adjust it, right? So there's a lot in here that you can do when you have those kind of simultaneously running together. All right, so the last thing that we have to look at is we have to figure out what is this mystery one here. This is the most important one of the whole thing. So if you don't listen to anything in here, listen to this part here about paper trading and backtesting. And this is the thing that's similar across both of them, and it's the most important point. And it's that both of these lack the reality of live trading. And I can't stress this enough, because You can backtest lots and lots of different things. You could backtest things that in theory could work out, and you could test them in theory, and they just don't work out in a live environment. And the same thing is true of paper trading. In paper trading, you could, in theory, have a position that closes because it's paper trading, because we don't know if it would really close. So nothing is as good as live trading, which is why I suggest all the time that if you do backtesting, you do paper trading, use them as tools. They are tools that should be used to help you as a trader eventually get to the point of starting live trading, because nothing compares to the reality of live trading. So paper trading versus backtesting, here's my take on which one to use and why and how I use them, and I'll give you some examples. So like I said, both serve a purpose. They are useful tools. Don't look at them as anything other than tools. A lot of people look at them as like mystic crystal balls that will show you the future and show you the perfect strategy and the perfect environment. That's not what they are. They are purely tools. Ultimately, you need to quickly transition to live and real trading as soon as you can, because nothing compares to live markets for both execution and emotions. It's just the reality. You can never appropriately gauge or predict or try and model a live environment. It's never going to work. Not even the best paper trading is going to perfectly mirror a live environment. So you got to get to live trading as soon as you can. That being said, backtesting for me is a way to, I always say this too, like hone in on a conceptual framework or strategy. It gives me guardrails. I've used this in like that analogy a number of times where it's like I can drive down the road and I have a little bit of wiggle room, but the guardrails are there to prevent you from falling off a cliff, right? And so I think that backtesting for me is mentally that exercise. Is I want to test strategies to make sure that what I'm doing, even if I start to adjust the wheel a little bit, is ultimately not going to lead me off of a cliff. So, and it helps avoid, I think, major errors. So let me give you an example. So this is a really good example of this because it conceptually talks about what I'm saying, which is that if I were to backtest this strategy, and I did, and this is why I have this backtest available, is I backtested this idea that somebody had shared, and I had said, well, maybe it would do this idea. And it's basically entering positions early in the morning, right? So you enter these SPX iron condor positions, 0 DTE style, at around 9:40 in the morning. So basically right after the market opens, you get into a position. And then I tested a bunch of different profit targets. I was like, well, you hold it all day. What if you got out half? What if you got out most of the day? What if you got out really, really early? Because I hear people say that all the time too, is like, well, get into a trade early, but get out early, right? But what you see is that conceptually, like framework-wise, none of these things worked out. In fact, all of them were absolute dog losers. So it didn't really matter how much wiggling you did to the wheel, to use our driving down the road analogy. It didn't really matter how much wiggling you did to the wheel. Everything that you did didn't work out. Like conceptually, you're still driving off a cliff. Maybe this, maybe strategy D drove off a cliff a little bit later and strategy B drove off a cliff very early in the day. Like it doesn't matter, but it just conceptually didn't make sense. Now you can pair this to something like this, which is testing a little bit different strategy, late entries, so 315, just in this example. I'm not saying this works for everything. And then testing it across different ticker symbols as well. So like using the same ticker or the same strategy across multiple symbols. Although you had lower entries on these symbols, there just wasn't as many trades as you could get into for the other ones. Do you notice how all of these are kind of trending in the same direction? Like conceptually, I'm moving in the right direction. And even if you go down to the stats, like some of these stats are all very, very similar. Like win rates were in the same ballpark. Profit factors were all broadly in the same ballpark. You still made money on them. They still had lower max risks and mass drawdowns. Like these are for different symbols across the board. Again, I'll share all these links in the below this video so you can take a look at these and run different variations of your, if you want to. But this is really important, is like you have to use backtesting to get the broad strokes in place. Like what generally should I be trading? And if I were to answer it just between these two combinations, this one would say, okay, well, you're generally not going to be entering positions early in the day. You're generally going to be entering positions later in the day for 0 DT, right? So if that was like the broad concept, then I could kind of hone in on it a little bit more with other backtesting criteria, with other things that I'm kind of looking at. So that's how I use backtesting for me. So I do a lot of backtesting. You could also, it's a lot of research, other backtests, other research that other people have done, also a great idea. but like that's a really good way to find kind of the framework around the strategy that you're going to be trading. Now, paper trading for me is a little bit different. I mostly use it as a tool for refinement and correction of the strategy I've already researched. So I'm not going to use paper trading to just randomly test ideas that are out there. That seems like a waste of time to me personally, because you just can't get enough data quickly. And the time it would take to get all the data from a paper trading strategy is wasted time that I'm not trading something else. So for me, paper trading is not a tool to discover new ideas. I've already had an idea using backtesting. Paper trading is a way for me to improve refinement and correction of the strategy that I'm trading, and to kind of stress test it to a certain degree in some live environments and make sure I'm not missing anything. So like I said, I've already researched and backtested a strategy before it gets to the paper trading. For me, it's a way to, I say, like a dry run of the strategy. Make sure that I've got everything accounted for. I'm not forgetting something. So I'll certainly paper trade a strategy very quickly for a week or two before I turn it on live, because mainly what I'm doing at that point is just making sure, did I account for, just weird things that might happen in pricing? I'm going to check the positions. I'm going to make sure that I'm not trading something that's super liquid, right? Or that I thought was liquid and now, the reality is it's super illiquid. So there's a lot of things you can do kind of in paper trading. And I think one of the things you can do, again, it also is run strategies side by side with your live trading. So here's some examples of that. So that kind of helps show you what I'm talking about. So here are two bots that I selected in our Analyze tab. So I went down here and I've traded these two strategies. They're exactly the same bots, just one is in paper trading and the other is live. So this one here is our live bot. This is a QQQ EV bot. And this one here is a QQQ paper trading bot for the same exact strategy. So I just clone the bot. I run the same live bot next to the same paper trading bot so you can kind of see the difference. So if I just go here and if I just toggle back and forth between the live and the paper bot, so you can see this is the live bot, this is what it's done. And then if I go to the paper trading bot, this is what the paper trading bot has done. So if I just literally go back and forth, I can see the difference between these two bots, which is the exact same strategy, live and paper. Now again, we're never going to get perfectly the same results in paper as in live. You just can't do it. You can't mimic paper to live exactly the same. And so here, what you can see though is you can see broadly the curve of the strategy is about the same. And this is just right now, so it might roll over. I'll show you another example where it kind of rolls over too. But you can see that it did have, in the live example, had a little bit of trouble here. It had some trouble, and then it went on a good run, and now it looks like it might be starting to roll over. Well, here in the paper trading, like the same thing is happening. So you have here where the paper trading, you had some struggles here, went on a little bit of a run. Now it's starting to turn over. If you go back and forth between paper and live, you get win rates that are about the same, like in the same ballpark, 77.4 and 78.4, right? You get profit factors around the same. You get some of the metrics around the same. So this is a good indication that maybe, again, it's never going to be perfect paper versus live, but you're kind of skating in the right direction, that the difference between these two is not too dramatic. So let me show you another example here. This is the Pure EV portfolio of bots. So this Pure EV paper trading has been running a lot longer than the live environment, but the same conceptual thing can be shown here, which you can see that in the paper trading environment, these bots right here had lots and lots of troubles for quite a while, just kind of getting their trade count up. But once they got their trade count up, they had a good little run. They've gone on a little bit of a down move, obviously. But again, that's what you can kind of see here. So you got win rates around 77%, profit factors 1.2. If I go to the same trades in a live environment, so the same number, I don't have as many trades as that one has right now. So it's still kind of building up that trades. But again, you see the curvature of the graph is very similar. We had some struggles at the beginning. It's starting to pick up a little bit. It's gone through a little bit of a downturn. Profit factor is still 1 right now. Win rate is creeping up. So we don't have as many trades, but I wouldn't be concerned about this one right now because it's still building up its trade balance and its trade count. And if I look at the paper version of this portfolio, I know that I've got a lot of trades. I've got a lot of trade count in there. So it's the same thing running in paper as in live. And so those differences can start to reveal themselves over time. So I think that this hopefully helps out, just kind of showing you, again, how I use it. Again, paper trading for me Like I said, I'll go through and run a paper trading strategy for just a little bit, just to kind of iron out the kinks. Then I'll turn it on live and I'll continue to run, in many cases, the paper trading bot right next to it, so that eventually I can see how closely those things might track together. Again, it's not that they should be perfectly together, because they won't, because live will never be the same as paper, but it will be that they should be generally skating in the same direction. They should be moving as a team generally together. You shouldn't have a wide disparity. Again, if you have a wide disparity, that means you're not doing something right with your paper trading strategy. That means you're not setting up your paper trading bots the right way to kind of mimic as close as you can a live environment, or you don't have the right expectations. All of those we'll talk about in an upcoming video soon. So I hope you guys enjoyed today's presentation and kind of going through the differences between backtesting and paper trading, why I use them both for trading and for researching strategies. But I kind of lean a little bit more, like I said, on backtesting and research broadly, find a strategy, and then use paper trading to kind of hone in or course correct on that. And it's a great tool moving forward to analyze theoretical versus actual markets. So if you have any questions, please let us know in the comments below. If you like this video, let us know. Also, give it a thumbs up, share it, spread the word about what we're trying to do here at Option Alpha. And until next time, happy trading.